Property, plant and equipment cost basis. We'll be discussing overview of PPE, valuation of fixed assets, property, plant and equipment, and of course finally the fixed assets constructed by a company involving some borrowing costs. So let us start first with property, plant and equipment. Means what? Property, plant and equipment are long-term physical assets that a company uses for its operations, of course not for resale. So let us discuss some key features of property, plant and equipment. PPE are long-term assets. Yes, they have a physical presence, they are tangible assets, and they are intended for use in the business for a longer period of time. Subject to depreciation means over time these property, plant and equipment, they lose value due to usage or maybe due to reduction in value as they become inadequate. Types of property, plant and equipment. Land. This means the land the company owns for business. Buildings, plant. This includes building and structures used for business operations. Equipment. This includes machinery, tools, furniture, other fixtures. Accumulated depreciation account, sometimes called provision for depreciation account. This is a contra asset account, just like allowance for uncollectible accounts. Like if the cost of your assets is, let's say, $100,000 and depreciation charge so far on that particular asset is, let's say, $30,000. $70,000 is what you call the carrying value or the book value. This $30,000 is the accumulated depreciation. This is the cost. We'll discuss this as we go along. So basically, this account shows you the total depreciation that has been recorded against that particular asset or the group of assets. We'll see it in detail. Valuation of fixed assets. There are two key points that you need to remember. First, that the assets are reported at historical cost, mean the original price paid to purchase an asset to bring it in its operational condition. For example, if we buy a machine for $50,000 and we spend $5,000 to install it, so the total cost would be $55,000, right? All the installation costs, freight costs, testing costs to bring that machine in working form is called part of the cost, so it's capitalized. Donated fixed assets. Donated fixed assets mean that sometimes a company receives a fixed asset as a donation. So in that case, if a fixed asset is received as a donation, it is recorded at its fair market value. For example, we received an asset that has a fair market value of $10,000 and we had to pay some incidental costs in preparing the asset for the use. Let's say $5,000, let's say $500. So we will debit the fixed asset with $10,500. This $10,000 original fair value, we reported as a gain on non-reciprocal transfer. So this is reported as a part of your income statement as a gain, and remaining $500 which you paid, in fact, becomes part of the cost of the assets. Next, we have property, and the first asset under property is cost of land. This is important topic because land is not simply land. There are many elements of expenses. They become part of the land, right? Become part of the cost of the land, right? So what we're going to discuss is certain expenses which are included when calculating the cost of the land, particularly if the land is purchased for constructing a building. So what it would include: first, the purchase price, the amount we pay to buy the land, then broker's commission, the fee we pay to real estate brokers who helped in this transaction, title and recording fee, yes, cost relating to legally transferring ownership of the land from the seller to you, the buyer, legal fee paid to lawyers involved in the purchase process, draining swamps, any costs associated with making the land suitable for building, any expenses to clear the land to make it ready for construction, clearing of brush and trees. Site development, these are the costs related to preparing the land, like leveling it or maybe grading it for construction. Existing obligations assumed by the buyer. These include any unpaid mortgages or any back taxes that the buyer takes on and he would be responsible to pay. Cost of raising an old building, yes. The cost to demolish any structure already on the land would also be included as a part of the cost of the land. Yes, less proceeds from the sale of existing items on the land means if there were some materials related to some timber removed or some remains of standing building debris and it's sold, then it is deducted. So the proceeds you would receive, they are deducted from the total cost of the land. Land improvements are enhancements made to the land, and these are treated as separate assets and they are depreciable, meaning they lose value over time, so they have to be written off in our accounting record. So common land improvements include, number one, fences for boundary or security purposes, water systems, maybe for irrigation or for drainage, sidewalks, these are the paths or walkways added to the property, paving, roads or parking areas paved on the land. They all are depreciable assets, not a part of the land, rather land improvements. So they are not part of the land, remember. Landscaping means improving the appearance of the land with plants or grass or certain items. Lighting, installation of outdoor lighting. So all these items are treated as separate depreciable assets. They are separately depreciated as individual assets. Interest cost incurred during the construction period of a building or any other asset should be added to the cost of that land improvement. Please remember, this loan should specifically be for the construction of the building or other asset, and any interest cost payable on such a loan is added to the cost of the land improvement. But there is an important concept that you need to remember, that not all the interest is added to the cost of that asset or the improvement in the asset. Let me show you how it is calculated using the weighted average of accumulated expenditures. Just in a minute. Suppose you are constructing a building and you spent money at different points in time throughout the year. So let's say the total construction cost of the project is funded by a loan, and let's say the interest rate on loan is 8%. So here is some spending. We spent 100,000 on 1st Jan. We spent $200,000 on 1st of April, July 1st, October 1st, right? So total spending is 1 million. So the months outstanding, this amount spent on 1st January remained outstanding for 12 months, this for 9 months, 6 months and 3 months. So if you multiply each of these figures with the number of months outstanding, you get a total of $6 million. Now here is the important calculation. $6 million divided by 12 months, that means the weighted average of accumulated expenditure is $500,000, and interest rate we're going to use is 8%. So that means $40,000 is the capitalized interest, which will be added to the cost of the asset, right? If you find this little difficult, then I would recommend another alternative. Instead of just multiplying it with the number of months, what you can do, you can simply take this amount and multiply it with 12 upon 12. Remained outstanding for 9 and 9 by 12. It's going to be 6 by 12. 3 by 12. If you simplify, you get the final figure that I calculated, $500,000, and simply multiply it with 8% and you get the same figure. So multiple ways of doing it. Next we have plant or building. Please note the cost of plant or building includes all the expenses incurred to acquire the asset and make it ready for use. And it includes what? Purchase price, the amount paid to acquire the property or plant. Repair charges, deferred maintenance means any repairs that the previous owner neglected, which you now need to cover. Alteration and improvements, any changes or upgrades made to the building. Architect's fee paid to the architects for designing or perhaps overseeing the construction. Construction period interest, that we just discussed a little while ago. Interest incurred during the construction period, which can be added to the cost of the building. And then it says another topic under the title plant or building, basket purchase of land and building. Basket purchase basically means buying both land and building together for a single price. So to allocate the purchase price between the land and building, let's say we acquire a building and land together for an amount of $1 million. Now we need to allocate this between land and building. So how do we do that? We don't do it arbitrarily. To allocate the purchase price between land and building, you need to use the ratio of their appraised values of each individual item, right? So let's say the appraised value of these two items are in proportion of, let's say, 60 and 40. That means 60% of 1 million goes to land, 40% goes to building. And this clearly will help us record these assets separately on our balance sheet. One important twist could be that maybe land and building, we have paid 1 million, but their appraised value are, let's say, $500,000 for the land and let's say $700,000 for the building. That is 1.2 million, whereas we paid 1 million. So we will use the proportion of 5 and 7. That's 5 and 7 means 12. So 5 by 12 of the 1 million amount goes to land and 7 by 12 of 1 million goes to building. That's what it means when you say the proportion of their appraised values. Equipment includes machinery, fixtures, furniture, office equipment, and of course the factory equipment. Cost of equipment refers to all expenses which are in relation to acquiring or constructing an equipment. So let us discuss each. First, invoice price, the price listed on the invoice or the bill for equipment. Less cash discounts means any discounts offered for early payment or for any reason, they are deducted from the invoice price. Freight in, this is the shipping cost for delivering the equipment, including insurance while the goods or the equipment is in transit. Installation charges, clearly the cost for installing the equipment. It also includes testing or maybe preparation required to make the equipment operational. Sales and federal excise taxes, yes, taxes paid on the purchase of equipment, they are also part of the cost. And then finally, construction period interest. We discussed this a little while ago. Any interest cost incurred during the construction period may also be added to the cost of equipment. We have spent some money on an asset. Will it be added to the cost of the asset or will it be expense? Proper accounting is determined based on the purpose of the expenditure. So it's basically capital and revenue expenditure, which you guys might have done it in your earlier studies. Additions. Additions are expenses that would increase the quantity of the fixed asset. And of course, they're capitalized. Like you buy a new piece of machinery, right, attached to the existing piece of machinery. So you debit your asset and credit your cash or accounts payable, whatever the situation might be. Improvement and replacements. This is a bit tricky. Please make sure you understand it well. Improvement and replacements, there's a fine line. Improvements increase the quality or the usefulness of the fixed asset, whereas the replacement simply involves substituting an old asset or old part with a new or similar one. So they are capitalized, but the treatment depends on whether the carrying value, which you call the book value of the old asset, is it known or not known. If the carrying value of the old asset is known, which is being removed, so it's like a disposal of the old asset, so you recognize the normal gain or loss. The cost of improvement or replacement, it is capitalized. But if the carrying value of the old asset is unknown, and such an improvement extends the asset's life, so you simply debit accumulated depreciation with the amount, let's say $5,000, and credit cash or accounts payable, whatever the case may be. And third case, if the usefulness of the asset is increased, so whether it's an improvement or a replacement, capitalize this cost of improvement or replacement to the asset itself. So you debit the asset and credit cash or accounts payable. Repairs are treated as an expense and simply charged as maintenance. So there is a difference between two types of repairs, ordinary repairs and extraordinary repairs. So ordinary repairs are just like repairs, we charge it as an expense to the income statement. But if it's an extraordinary repairs, means significant in amount, it should be capitalized if they increase the asset's value. So these will be treated similar in the same way as if it's an addition or improvement to the asset. So here's a summary chart that sums up what we have done. If the spending that you made, if it increases the quantity, you capitalize it. It's either improvement or replacement. If it increases life, you debit accumulated depreciation, credit cash or AP. If it increases usefulness, you debit the asset and credit cash or accounts payable. If it's an ordinary repair, expense. But if it is an extraordinary repair that increases the life of the asset, you debit accumulated depreciation, credit cash or AP. But if it increases the usefulness of the asset, then you debit the asset, the spending that you made, credit, bank or your AP. Fixed assets constructed by a company. Which cost to capitalize? When a company builds a fixed asset itself, several types of cost are added to the value of the asset. First, the material and labor, wages directly tied to the construction, repairs and maintenance, only those that increase the asset's value, and overheads, that is the indirect costs like electricity, gas, water, utility, administrative expenses that relate directly to the asset construction. And finally, the construction period interest, which we discussed a little while ago, interest that is accrued on the money borrowed for construction of this particular asset. Capitalization of interest cost. We discussed this topic a little while ago. Means interest costs relating to constructing fixed assets. They are added to the cost of that asset based on certain rules. First, for assets under construction, like buildings or machinery, interest costs are added during the construction period, not once the asset has been completed. No interest after that can be added. For fixed assets built for others or sold or leased, interest can also be capitalized. And then finally, land improvements. If a structure is being built on land, whatever the structure could be, we discussed land improvements a little while ago, the interest is capitalized for the structure or not for the land itself. And then we have a next topic, computing capitalized cost. Weighted average accumulated expenditures, we discussed that in a little while ago. Let me show you. Weighted average accumulated expenditure, and we use it to calculate the interest cost to be capitalized. Weighted average of accumulated expenditures. Interest rate on borrowings. Yes, if the construction is funded through a specific loan, the interest on that loan is capitalized, but only during the construction phase. Interest on excess expenditure. What it means, if the money that you have spent on the asset is more than the loan amount, the interest on this excess should be capitalized using the weighted average rate. That is weighted average of the current borrowing, the new borrowings or the other borrowings of the company. Then it has not to exceed the actual interest cost. Yes, that is important. The total interest capitalized should not exceed the actual interest the company pays on its loan during the construction period. And finally, do not reduce capitalizable interest. Means you cannot reduce the capitalized interest if part of the loan remains unspent during the construction. On January 1st, year 1, Convisor Soup Kitchen Incorporated signed a fixed price contract to have a new kitchen built for $1 million. On the same day, Convisor borrowed $500,000 to finance the construction. The loan is payable in 5 $100,000 annual payments plus interest at 11%. Convisor planned to finance the balance of the construction cost using the company's existing debt, which had a weighted average interest rate of 9%. During year 1, Convisor had average accumulated expenditure of $600,000 and incurred actual interest cost on all borrowings of $150,000. Calculate Convisor's capitalized interest cost. Now, average accumulated expenditure is $600,000, of which $500,000 is from specific borrowing at the rate of 11%, and remaining $100,000 at 9%. So that means the interest you can capitalize is 11% of $500,000 and 9% of $100,000. That is $64,000. Now the actual interest cost is $150,000, whereas the capitalized interest $64,000. So not the because of capitalized interest, capitalizable interest of $64,000 is less than the actual interest $150,000. These full $64,000 is capitalized, and the remainder, that is $150,000 less $64,000, it is of course charged as an expense, interest expense in income statement. Capitalization of interest period. The question is when capitalization begins and when it ends depends upon specific conditions. When does capitalization begin? It begins when the company has spent money on the asset, or it begins when the work necessary to prepare the asset for its use has started. and it begins when the company is incurring interest costs related to construction. When does capitalization continue? It will continue as long as the three conditions I have discussed above are present, are met. What? Money has been spent on the asset, work necessary to prepare the asset is started, and the interest is being incurred related to construction. Right? If there are any delays during construction, during those delays, capitalization is halted or capitalization is not done during the time the construction has stopped. When does capitalization end? Clearly, when the asset is substantially complete and ready to use, then capitalization should stop. Then finally, disclosures in financial statements. What do we need to disclose? The total interest cost incurred during the period and the portion of interest that has capitalized for the period, if applicable.